In this episode, I'm breaking down the two biggest mistakes that new experienced traders, veteran traders, we all make these two mistakes when the stock market is down. And I'm here to help you snap out of it and don't make these two crucial mistakes because it can cost you thousands, if not millions. Welcome to the Money Markets and Mindset Podcast. I'm your host, stock market coach and option trader, Jason Brown. And man, the bears have been out in full effect lately. And I'm sure the retail traders are feeling it. Stocks have been totally selling off. And I want to talk to you about two mistakes that most people make when the stock market isn't going up. You see, most people always just are excited when it's going up. It's like to the moon. But where are these people at when stocks are going down? They're nowhere to be found. Where's the crew? Where's all your friends on GameStop, AMC? Where's all the Facebook feeds of all the people making a killing, making all the money? Where's all your friends talking about how easy this thing is? I don't need a course. I don't need a coach. I don't need a community. I got this. Where's all those people right now? All right. I don't know where they're at, but they're in hiding. Okay. The bears are eating their lunch. But I want to talk about two mistakes that most people make when the stock market is down. And I want to talk you through or walk you through what you should be doing instead of making these mistakes. All right. So let's dive into it. Mistake number one, I guarantee somebody out here is making this mistake. We're not going to be long with like 4 or 5 mistakes you're making. I'm just going to give you the top 2 mistakes. And number one, I guarantee somebody's out here doing this, is you stop looking at the market. I guarantee I'm talking to somebody right now, or maybe I'm going to be talking to you in 6 months because you're not going to pay attention to the market until things start going back up. But this is the number one mistake that most people make when the market is down. They stop looking at the market. They take their eye off the ball. They check out of the game. Coach calling a sub. I just want to go sit on the bench and drink some Gatorade. That is what most people do. They might not even want to drink some Gatorade. They just want to head for the locker room, get dressed, and they done playing the game. Now, here's why this is a mistake. Because when the market drops or continuously drops, when you check out and you stop looking, you're inevitably saying, you're waving the white flag, and you're basically saying what I've been saying all along, is that most people only know how to make money when the stock market goes up. And you're basically saying you don't care about the market unless it's going up. Now, we already established the market moves up, down, and sideways. So the other 66, 67% of the moves that it could potentially make, you totally check out. You only watch it when it's that 33% chance that it's going higher. And that is a mistake. Here's why. You're not honoring the craft. You're not paying attention to what is important, which is understanding the stock, understanding why it's selling off, understanding, is it a good stock and the entire market is just selling off? So it's just getting caught up in this. And really, do you have a good time to buy a good company that just got caught up in a bad environment because of Russia going to war, because of inflation, etc.? You're missing the key of investing or trading, because you only think this is a game of chance, a game of luck. You only pay attention when you can put all your money on black, like a roulette table, and hope when they spin the ball, it lands on the color black. Meaning you only excited about the stock market when you can put all your money on green. Meaning I think it's going up. And when it's not going up, you totally check out and you're disrespecting the craft. I'm telling you right now, you're disrespecting the craft. Here's what you should be doing, and here's the consequence of not doing this. And then we'll talk about mistake number 2. The first thing you should be doing when the market is down, well, you should pay attention to it. Don't be like most people and stick your head in the sand and be an ostrich. Okay. So don't make the number one mistake. Start watching, start paying attention, start asking questions. Why are things selling off? Why are things falling? What you're going to find in asking those questions as you start to get answers, you're going to find out who's a good company, like I said, and just falling just because that's just the temperament of the market right now. And then who's a bad company that can't survive inflation, that can't survive a war, that already was on the fringe of having bad customer service, declining sales, declining profit margins. And they're a bad company and should be falling, and most likely are going to continue to fall under this pressure. So you should be asking those questions. The second thing you should be doing is charting. And this is another mistake that most people make, but it still falls under the heading of you stop looking at the market, you're not paying attention, you're not asking the right questions. But number two, you're not charting. And when you're not charting, what you're really saying or what you're really doing is you're not looking at the technical levels where traders like to come in and buy some of these good companies. I guarantee you, if Tesla sells back off to $500 after being trading at what, 1,000, 1,100, 1,200 almost, if Tesla, I think Tesla's down like 769, I guarantee you there's a technical level where the traders, in fact, I'm going to pull it up right now. Now, if you listen to the podcast audio, obviously you won't be able to see the chart of Tesla, but let me pull up a chart of Tesla. All right. Because Tesla, as of recording this, broke the 200-day moving average today. And that put Tesla at about $762. I can guarantee you, if Tesla comes down to 500 and about 64, that is a technical level where traders and investors both look and say, I want to own this. I want to own a piece of this. But you can't find that number if you're not paying attention, if you're making the number one mistake and you stop looking at the market. You can't find that if you're not asking the right questions. Okay. And you can't find that if you're not charting. If you're not looking at the chart, this is not the time to stick your head in the sand. This is time to look at the chart and say, ooh, Tesla was just, I'm looking at it, Tesla in January 22nd. All right. I'm sorry, January 3rd, 2022. Tesla was just at almost $1,200 a share. It is now down to $764, almost $500 off. And some of you are not even paying attention and saying, man, if this, for whatever reason, gets down to 560 or falls another $200, I'm bouncing on it like a rat on the Cheeto. Okay. I am getting some Tesla. So you got to be looking at the stock charts. You got to be paying attention to where would you buy this stock if it continues to fall. You almost like, I hope it continues to fall. I'd love to own it at about 560, but you got to be paying attention. Number two thing that you should be doing when the market is falling, after you've asked some of those good questions, after you've done the charting, most importantly, the next thing that you should be doing after charting is setting alerts. Now, what do you mean I should be setting alerts, Jason Brown? You should be setting alerts. I just told you I like Tesla at 560. You should go in and set an alert and say, if Tesla falls to about 580, I want to know about it. Now, why did I say set an alert at 580 if I want to buy it at 560? Because we want to get alerted to start paying attention to this stock as it gets closer to the number. We don't know if it'll fall exactly to that number, but we just want to know if it falls within that range. I want to know about it. I want to get an alert set. And we talk about setting alerts inside our membership. There's a whole mindset process around setting alerts, but you want to chart it first. Then you want to set the alert down there around 580 so that you can get alerted when it gets in that general vicinity that you might want to be paying attention and possibly buying Tesla. The other thing is you could also set an upside alert and say, well, if it gets back above the 200-day moving average, perhaps it's going to hold right there. And maybe I want to start to participate if it's going back up. So bottom line is you want to set alerts. You don't want to leave it to your memory bank to be like, what stock was that again? And what price was it again? I think that's why most people check out, because they got to start from scratch. What stock? What questions to ask? Is it a good company? Is it a bad company? You should be doing that research now, charting and setting the alerts. So you already know if it's a good company or a bad company or not. You already know if it's falling because it's a bad company or because it's just market conditions. That research is done. Now you've already done the next research, is charted the technical levels of where you would buy it at. That research is done. Now you set the alert so you can go look at the next stock and do the process all over and over and over again. If you do this, you will wake up in 1 month, 2 months, 3 months. You have a bunch of alerts going off. You have a bunch of trading or investing candidates that you can put your money into. And you won't have to you'll know why the alert went off. You'll be like, oh, I said around 560, I was willing to buy it. You won't have to be like, well, what does Tesla do again? You like already researched what Tesla does. They make electric cars. Here's why I think is the future. Here's why I think they just got caught up in the inflation and the war. Here's why I believe they're going to bounce. You've already done that research, but you can't do that if you stopped looking at the market, if you took your eye off the prize, if you're disrespecting the craft. And these are the same people that say, I want to make $1 million. I want to quit my job. I want to do what you do. I want to trade full time. This is the work you must be putting in, especially when the market is going down. It's so easy to be dialed in when everything's going up. It's so easy. This is where the real investments are made. This is where the real traders make the majority of their money, because they're doing the homework. Now, here's the third thing that you should be doing right here, right now, after asking the right questions, charting, setting alerts. The fourth and most important thing you should be doing is raising capital. Yes, you should be raising capital. You guys don't understand. This is the time to sell your car, sell your watch, sell your TV. You might think I'm crazy, but I'm telling you, this is the time to sacrifice and raise capital. Why? Because a lot of great companies are on sale and they might get a little bit cheaper. They might sell off a little bit more. I hope they do, because I'm in cash raising mode right now. I am not in spin mode. Let's get another car. Let's get another watch. No. Care less about that stuff. I am in cash raising mode. In fact, you can buy a couple of my watches right now. Okay. You can buy a couple of things from me right now because I'm in cash. I want more cash in this market when things sells off. Why? Because we all know long term the market goes higher. So if I can start to snatch up some great companies on these pullbacks, give it 6 months, give it 12 months. We probably go get some ridiculous returns as inflation simmers down, as this Russia war thing passes over. How do I know it'll pass over? Because it always does. Didn't we get through 9/11 when somebody flew a plane into a building? Don't get much more at war than that. These cats ain't even bothering us. They bothering Ukraine. That ain't messing with us. This ain't even a real war. I don't want to say it's not a real war. I don't want that to come off the wrong way to someone who's in the middle of Ukraine or somewhere thinking I'm insensitive. What I'm trying to say is, in comparison to 9/11, that was a war. They hijacked planes, flew them into the building on American soil. That was a war. So my point is, if we got through that and the market got higher, we'll get through this Russia-Ukraine stuff. I can't tell you when, but we'll get through it and we'll be glad we bought a bunch of stuff when everything was selling off. Same thing, inflation. Our grandparents went through great inflation, way higher than 6-7%. We'll get through this. And when we come out on the other side, we'll be glad. Now, I'll give you some strategies. When we talk about mistake number 2, I'll give you some strategies that you can make some money right here, right now. But I'm just talking about raising capital and buying stuff for the long term, knowing that we will eventually get through this COVID-19. We'll get through this. We got through SARS. We got through swine flu. We got through mumps, measles, you name it. We got through it. So we will get through this. So we got to stay focused right now. We can't be like, oh, it's the end of the world. It ain't even close to the end of the world. We at war. This ain't even close to the wars we've had in the past. At least not yet. At least not yet. So you should be raising capital, making the sacrifice now so that you can buy some good stuff. So as it starts to turn around and return, which no one knows the exact day, exact moment. But what I do know is that if I got a choice to buy Tesla at 1,200 and I got a choice to buy Tesla at 750, am I buying at the all-time highs or am I buying at a little bit of a discount? If I still believe Tesla is the future and I got a choice, would I rather have bought it at 1,200 and now it's down to 750 and I'm like, I needed to move 500 points just to break even? Or would I rather be coming in looking at buying it now around 750, saying if it gets back to 1,200, I'm up 500 points? So you got to think like an investor. You got to think like a trader. Don't go running scared and stick your head in the sand like an ostrich like most people are doing. Don't make the number one mistake and stop looking at the market. Just to recap, you should be charting. You should be looking at stock charts, determining when would you buy, when's the technical levels of support. You should be setting alerts so you can get reminded when those levels get hit or breached so you can start paying attention. And then you should be raising capital so that you can participate in the move back up. Now let's talk about the number two mistake that most people are making right now and they make throughout their entire trading or investing career. The number two mistake that most everyone makes is that they do not know how to play the downside. You are just, and trust me, I get it. If you don't know how to play the downside, listen to me closely because I know exactly how you feel. If you don't know how to play the downside, you are looking at your account every day and you're watching it bleed out. You're like, it's down again today, another $5. You're like, okay, this should be the end. You wake up tomorrow. It's down again today, $7. You're like, when is it going to stop? Ask anybody that's in Facebook. You like, when is it going to stop? They miss earnings. Boom, sold off 100 points. You like, it got to be done. Facebook sold off another almost 40, 50 points since then and continues to sell off every single day. If you don't have the strategies, you are just looking at your account bleed out. And that's mistake number two. But mistake number two causes mistake number one. Because you're watching your account bleed out every single day, you don't want to look at it. And I don't blame you. Who wants to go up and be like, oh, lost 10,000 a day. Wake up tomorrow. Oh, lost another 10,000 a day. I'm down 20,000. Wake up the next day. Oh, would you look at that? Down another 10,000 today. Who wants to look at that? You like, you know what? I ain't even gonna look at it. After day number 3 or 4, you like, I'm good. I don't even want to look at it. And now you fall into mistake number one. You don't even want to look at the market. And you don't want to look at the market because you're making mistake number 2, which is you don't know how to play the downside. You don't know how to use put options. You don't know how to use spreads to raise cash and then turn around and buy put option. You don't even know what the heck I'm talking about. What's the spread? What's the put option? What's insurance? How do you play the downside? So of course you don't want to look at the market. I'm like licking my chops. I sent the alert out to our members today. I'm like, look at Lowe's. It's about to be the next Home Depot. Home Depot reported earnings. Pow, gap down almost 100 points. How many? Not 100 points. Let me see. Let me pull it up. Let me see. Somebody could be like, it didn't gap 100 points. It fell from 346 on the first day to 317, and then today down to 308. So 346 to 308. And when I say it fell 100 points, I meant from the time it was at its top, where it had a double top, which December it hit a top, and then December 31st it hit the top. So it's like December 1st and then December 31st it had a double top. And since then, from 416 to where it's at now, 308, which is what I meant by it fell over 100 points. I said, mark my words. Lowe's is most likely next. They reported earnings, gapped up, sold off. I think it goes lower. What do you think me and the members did? We backed the trucks up. We got some put options. But if you're not in the community, if you don't know how to play the downside, if you're not paying attention, that's what I'm here for. I send out the alerts. I'm paying attention. I'm like, hey guys, don't fall asleep at the wheel. Are y'all watching this? Did y'all get that text alert? Okay, so mistake number 2 is you don't know how to play the downside. You don't know how to make money from stocks falling. And even if you're not making money, you don't know how to stop the bleeding in your account. You just wake up every day depressed that it's lower and lower and lower. And I get it. Then you go back to mistake number 1. You're like, I don't even want to look at this. And then you wake up in like 6 months and wonder why you're not making no money for the stock market. Then once everything turns back around, you're like, I haven't even been watching it for 6 months. What's going on? I got to get back acclimated with the stock market. And you're like, bro, you should have never checked out. Baby girl, you should have never checked out. This is the time to swipe the card and punch in. This is where we go to work. This is not where we go to sleep. This is where we go to work. All right, so let me give you some tips for learning how to play the downside. Number 1 thing is you have to understand if it's not going up and it's not going sideways, it's probably going down. That's the only other way it could go. These market stocks are not going up, it's not going sideways, it's going down. Okay, so if it's going down, you got a couple strategies. Here's one strategy that most people have. I'm just going to wait. And long term is going to come back. That is a strategy, but I would argue that strategy does not make you feel good every day watching your account dwindle, get lower and lower and lower. Second strategy is you can sell covered calls against the stock you own. You say, well, what's a covered call, Jason Brown? If you don't understand what a covered call is, this is why you need the education. This is why you need the education, period. Hands down. If you watch somebody's free YouTube video and don't understand it, this is why you need the education. Because you watch the free video and you still don't get it. You still don't understand it. You still don't know what strike price, what expiration, what date, what to do at expiration when it closes out. What happens if you get called away from you? This is why you need the information. Another strategy. So you can just wait, hope and pray. It goes back up. You can sell covered calls. We also you can buy short and long-term puts. So that's a 3A and B. You can buy some short-term puts to cover the downside momentarily. You can buy some long-term puts if you believe the downside is going to continue. But if you don't know what a put is, what strike price, in the money, at the money, out the money, what expiration, how far you think it's going to fall. If you don't understand how to do that type of technical analysis and research, you got to get in the right rooms. Or you go back to mistake number 1. You just stop looking at the market. Or even worse, if you've never been in the market, unfortunately for you, you're like, that's why I don't invest. That's why I don't trade. Everybody talking about how they portfolio down. That's why I don't even get into that stuff. And that's probably the third mistake, which is a whole nother lesson. Is like, people believe that when the market's down, it's not the time to get into it. Wrong. This is the best time to get into it. Because if you got into it at the all-time highs, you'd be like depressed right now because things have sold off. So if you don't want to buy at the all-time highs because it might sell off, then when do you want to buy? When things sell off and are kind of low before they turn around and rebound. So don't make mistake number 3, but we're going to still talk about mistake number 2 because there's only 2 I want you to pay attention to. Mistake number 1, you stop looking at the market. Mistake number 2, you don't know how to play the downside. So again, if it's not going up, it's not going sideways, it's going down. That might sound real simple, but you need to say that to yourself to snap out of the trance that you're in. Because what we start to think is, I would buy a put option or do something, Jason, but what if it turns around and goes up? Well, that goes back to number 1. Are you looking at the chart? And mistake number 1, if you stop looking at the market, then you're not looking at the chart. You're not looking at where it could turn around. And we got a little ways before things maybe turns around. And so we got a little ways to play the downside potentially. Who knows for how long? All right. So ask yourself, if it's not going up, it's not going sideways, it must be going down. Okay. Now you broke the trance Now the question is, what are you going to do about it? Okay. Second thing I want you to remember is that stocks fall faster than they rise. You ever seen a chart where a stock took, we could look at Facebook, for example. We could take Facebook. I don't mean to keep harping on Facebook, but I know a lot of people are familiar with the company. If I take Facebook, I can go all the way back to June 30th, 2020. June 30th, 2020. It took from June 30th, 2020 to September 21st to reach an all-time high. September 2021. It took from September to literally February 23rd to fall from 380 down to 198. Almost 200 points. Okay, so it took September, you got what? September, October, November, December, January, February, 5 months. The other way, it took almost 2 years to get that high, but it took 5 months just to get back down there. 5 months wiped out 2 years. And most of that was wiped out in like one day when it fell from 327 down to 200 and some change. It fell over 100 of those points in one day. In one day. So stocks fall faster than they rise. Why is this important? Well, number 3, you can make money back faster. The money you didn't make going up and that you're losing because it's going down, you can make money back faster from stocks falling. The money that you've lost or that you're down, you can make it back faster. So if you lost hope, I don't care if you're down 5,000, 50,000, 20,000, 100,000. When you're waiting for stocks to go up, it's going to be a long time for Facebook recovers from 100 plus 200 point drop. That don't just wake up and be like, oh, it's back up 200. It could take a year, 2 years, 3 years, 5 years. Who knows? It don't just like, oh, we changed our mind. We got to go through new quarters, reporting earnings, see if the numbers are growing, see if users are coming back. That is a process for that money and faith to come back into that stock. But guess what? Since they reported earnings and it gapped down 100 points, it's fallen from 237 to 197. It's fallen another 40 points. If you had, let's just do some quick math. If you just had 20 put options, 20 in the money put options, and it fell 40 points like it did, that would have meant $80,000. And guess what? It fell those 40 points. And let me see, I'm looking at the chart. From February 3rd to February 23rd, in 20 days, you would have made $80,000. So I don't care if you lost 100,000 from it falling. In 30 days, you could have made 80,000 of it back as it continues to fall. What's my point here? I'm just using Facebook as an example. My point is what I started with. You can make money back faster because stocks fall faster than they rise. So just by switching your thinking, learning the strategies, learning how to make money from the downside, you can literally replenish your account faster than you can just say, I'm just going to wait for things to turn around and come back. No, join the party. Join the bears. Let's go eat some of these people's lunch who don't know how to make money on the downside. Let's go eat their lunch. We over here licking our fingers like we good. We just ate. We about to go eat another meal tomorrow because I got put options. It almost feels un-American because you're looking at companies like, keep on falling, right? You're rooting for it to go down, but not really. It's just you understand the game and you're like, hey, if it's not going up, then it's going down. If it's not going up and sideways, then it's going down. Why should I have to sulk and lose money? Because the stock market don't want to go up. Newsflash, we don't have to sulk. We don't have to hope. We don't have to pray. We don't have to go see a therapist. All we got to do is learn how to play the downside. So as we wrap this up, I want you to think about it. Mistake number one is you stop looking at the market because things are down. Do not make mistake number one. If you're making mistake number one, snap out of it. I need you to come back. I need you to start charting, setting alerts, and raising capital. Okay? And then mistake number two, if you don't know how to play the downside, I need you to get educated. I need you to get educated from me, from somebody else, whatever. I hope it's me, but whatever. Get the education, get the training, get in the room, get in the community, get around the people. Because if it's not going up, it's going down. And then stocks fall faster than they rise. And you can make any money back you've lost faster from the downside than you can wait for it to turn around. If it turns around. Let's throw that in there. All right. So snap out of it, tap in, come get this information, and let's get this money. I'm signing off saying, you never go broke taking a profit. I'll see you on the next one.